Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about a trading strategy that captures the attention of many traders due to its potential for significant gains, known as the boom and crash trading strategy. Now, this approach involves navigating the intense volatility that could occur in certain markets where price can skyrocket or plummet in a matter of minutes. If you are interested in learning how to capitalize on this sudden price movement, you are in the right place. So by watching this video to the end, you will gain a comprehensive understanding of what the boom and crash trading entails and how to implement it to your own trading practice. Now, what is the boom and crash trading strategy? This involves navigating an extreme price movement in the financial market. This strategy focuses on two key events. The first one is a boom, which is a rapid increment in price followed by a crash, which is a sudden decline in price. Understanding the boom and crash pattern. The boom occurs when there is a sudden spike in an asset price. When there is a sudden spike in the price, then it is actually driven by a major news event or shift in market sentiment. Conversely, a crash happens when there is an upward momentum and it reverses, leading to a rapid price drop. This pattern is similar to the pump and dump scenario seen in cryptocurrency. So if we are to look at the boom and crash, we can trade this boom and crash strategy in the financial market, the synthetic index, any of them. These are where we can look at this strategy. Now let's look at an example of this strategy on our financial market. Now, as we can see from the screen, we can see that in this ox pair Australian USD dollar, we can see this is a crash, a rapid movement to the downside, and this can be a boom. So this particular boom and crash strategy can work in any given pair. Now, the boom and crash index are synthetic index because they are offered by some brokers such as the derivative broker. This index simulates market conditions, allowing traders to simulate on price movement without trading actual assets. They are highly volatile and can only be traded by specific brokers. Now, this is one of an index. This is the crash 1000 index. They are very volatile and they can only be traded by few brokers that we know. Several factors that influence the boom and crash. They can be triggered. There are some factors that influence our boom and crash strategy. The first one is major news events. They can be CPI news, they can be um a news event where an important person is talking. Large investors are using emotions. They are trading with large emotions. Some of them are trying to remove their funds from the market. Some of them are trying to pump more funds in the market. So because of this factor, the market move in a very swift fashion. It booms and it crashes depending on whatever the market maker does. Understanding this factor is crucial for anticipating and trading these events effectively. Now let's look at the boom and crash trading strategy. We'll look at a step-by-step guide to help us navigate these volatile markets. The first step is to choose a time frame. The 2-day time frame. When trading boom and crashes, it is essential to use shorter time frame. You can use shorter time frame, short as your 5 minutes or your 1 minute. It is nicer that way to capitalize on the short time frame. This time frame allows us to react quickly to market condition. The second step would be to identify strong market condition. identify the potential boom or crash, you have to look out for breakouts from consolidation. When you see a little bit of consolidation, it means that we are expecting a breakout either to the upside or to the downside. This is what we are going to use to anticipate such moves. As you can see, there is a little bit of consolidation in this area. The next thing, we crashed to the downside. If you can look at this, there's a little bit of consolidation at this area. Before you know it, we boomed to the upside. So this strategy is basically just looking out for a little consolidation, then a breakout for to either the upside or the downside. This is basically what the strategy is. Additionally, you have to analyze your volume indicator, because your volume indicator helps you to know if there is volatility behind the breakout. You can confirm this by an increase. It can be confirmed by an increase. I don't know why this indicator is not working. It can be confirmed by an increase in the market activities. High volume often precedes significant price movement. So when this is backed up by your volume, you would confirm the move. Now we can also use other technical indicators such as the relative strength index and moving average convergence and divergence. This can help us confirm the momentum. For the RSI, is always good to see if the RSI is trading above 70, which will indicate an overbought condition. As you can see at this area above 70, this is an overbought condition. When we notice there is an overbought condition, we should know that a reversal can occur or a ranging market can occur at that area. And as you can see, after the overbought zone in this area, we entered a little bit of a ranging phase before the market kicked to the upside again. And we can notice that at this point, price was above 70 again. Before you know it, we entered into a ranging phase. So we have to combine this strategy with other indicators such as our RSI. Now the RSI, when it is below 30, you should know that it is an oversold condition hinting potential boom. Remember, when it's above 70, it is an overbought condition that is signifying a potential crash. While when it is below 30, it is an oversold condition which is signaling or hinting at a potential boom. This is what you need to know about this strategy. Now the step 3 is to set clear entries and exit points. Now for boom, to enter trades, you enter the trade by when price breaks above key resistance level. I told you that we are drawing a box, and this box will act as both resistance at the upside and support at the downside. So when price breaks above this key resistance level, this is a signal that we should enter the market for a buy trade, or we are anticipating a potential boom. While for crashes, you enter the price when it breaks below crucial support levels. Like this example here, I told you that this rectangle acts as both resistance and support. So when it breaks from the support area of this rectangle, this is when you would want to enter your trade for a short. When you enter for a short position, it is how you anticipate a potential crash using the boom and crash strategy. Now the fourth step would be to implement the price action strategy by analyzing and studying candlestick patterns. You can use certain candlestick patterns for your boom and crash strategy. If you are not trading on the boom and crash index, you can use this strategy for other forex currency pairs. You would anticipate, you can use your hammer, you can use your pin bar to confirm entries before you enter your pair. The fifth step is by using an indicator known as Ichimoku cloud. You can actually use your Ichimoku cloud in this strategy. The Ichimoku cloud is a powerful strategy, a powerful tool for identifying potential boom and crash points. You have to wait for price to approach the cloud point for a potential boom, and you have to wait for price um to approach the resistance point for a potential crash. This can be a strong signal to enter your trade. So when price is approaching your potential cloud point, you are anticipating a potential boom. Then when price is approaching below the potential cloud, you are expecting a potential crash using the Ichimoku tool. Now the sixth step is to apply moving average. You can apply your moving average to the 1 minute time frame. This is where it is best used. You can apply the 1 minute moving average strategy. You will use this by combining the moving average and stochastic oscillator that can help you identify overbought and oversold condition. So applying my moving average to this pair and our stochastic oscillator. This would help us better understand this strategy. When you combine this, you know that at this point, this is an oversold condition. When it is below 20 in the market, oversold condition, and your moving average, you wait for price to come back to touch your moving average before you anticipate a potential buy trade or a potential sell trade if it is above 80 of your stochastic oscillator. Once it's above 80 in your stochastic oscillator, you are anticipating, you are trying to look for a potential selling trade because this would be an overbought condition. Then you are trying to capitalize on the swift move in the market. This is basically what the 1 minute moving average strategy is all about. These signals can actually confirm whether it is a boom or a crash that is likely to occur. Now the seventh step is to practice risk management. Remember, risk management is crucial in boom and crash strategy. Never risk more than 1 to 2% of your trading account on a single trade. So be prepared to exit quickly if the market moves against you, and to set realistic profit targets based on volatility in the market. So you can use a fixed risk to reward of 1:2 to get in and out of the market since we are scalping using this strategy. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I'll see you in the next video.